Hi, good evening, and welcome to all. I am Ridul Mishra from the corporate communication team, and on behalf of CareEdge, welcome you to our today's discussion on the housing finance sector. We sincerely appreciate your time in joining us for this webinar. And we would like to welcome our esteemed guest panel speakers for today. We have with us Mr. Conrad D'Souza, Member of Executive Management and Chief Investor Relations Officer. Along with him is Mr. Manoj Viswanathan, Managing Director and CEO of Home First Finance Company, and Mr. Sudipto Sil, Chief Financial Officer and Head of Investor Relations, LIC Housing Finance Limited. The session will be moderated by Mr. Sachin Gupta, Chief Rating Officer at CareEdge. We will commence the session with the presentation by Neha Kadyan, who is the Associate Director at CareEdge. And this will be followed by a panel discussion, and we'll be having a Q&A session with the audience at the end of the discussion. The format is such that in case of any queries, you're please requested to key in your questions in the panel. Now, may I invite Neha to begin the presentation, please. Thank you.
Thanks, Mridul. Good evening, everyone, and welcome to the CareEdge webinar on the housing finance sector. We'll start with the key takeaways first. So growth for the housing finance segment gained momentum last year, with the sector growing at 11% year-on-year, backed by low interest rates, improvement in the overall macroeconomic situation. While banks continued to dominate the housing finance space, HFCs were able to regain their lost share in financial year 22. Growth in the prime segment was supported by both retail and wholesale. However, loan against property, which is our LAP segment, dominated disbursements for the affordable side. High credit costs, primarily on the account of builder book, continue to drag the profitability for the prime segment. However, profitability profile for the affordable housing finance companies improved due to higher NIMs and controlled credit costs. Affordable housing finance companies were relatively much passed on the interest rate to the customers in a much slower way, which boosted their net interest margins. Asset quality, although improving for the retail segment on an overall basis, is still facing headwinds on account of the wholesale exposure. Capital structure for the sector continues to be modest, with affordable segment operating at relatively low gearing, as the risk appetite for the lenders was low and the market remained cautious. Coming forward to detailed presentation now. So banks continue to dominate. Housing finance companies regained some of the lost share. Refer to the left chart. So though banks continued to dominate and accounted for around 63% of the overall housing finance portfolio, this year, the financial year 22, was the year for housing finance companies. After reporting modest growth for 2 consecutive years, in financial year 22, HFCs reported double-digit growth rate and grew at 11% year-on-year, surpassing the 7% growth rate reported by banks. Consequently, the share of housing finance companies, which has been contracting for the past 2 consecutive years in the complete housing finance space, improved in financial year 22. Improvement in the macroeconomic environment, low interest rate regime, initial signs of recovery seen in the real estate sector were the key catalysts for this thing. Growth gaining momentum in the housing finance sector. So sector growth continued to be largely driven by the prime segment, which make up for around 90% of the overall housing portfolio. So growth in the prime segment continued to improve, with the sector growing at 9% year-on-year in financial year 22, compared to 8% in 21 and 5% in financial year 20. In terms of share of housing and non-housing loan, it largely remained stable at 73 and 27% for financial year 22. Please come to the chart at the right. So the affordable housing finance companies, traditionally, they have been growing at a significantly higher rate than the industry in the past. However, their growth moderated in financial year 21 due to COVID-induced pandemic challenges. However, this financial year, the growth outpaced the industry, with the affordable segment growing at a rate of around 20% year-on-year. Relatively smaller base, the ability to penetrate the unorganized segment, and strong appraisal skills to underwrite the below prime customers remained the key strength for the affordable segment. If we look at the share between LAP and the home loans, we see that the growth in the affordable mainly came from relatively higher yielding LAP segment. Accordingly, share of LAP increased from 19 to 25% of the overall loan portfolio. Coming to the yields part on the both charts, So we see that the large prime HFCs, they largely passed on the interest rate benefit to their customers. Decline in lending rates, along with reduction in the high-yielding builder book, resulted in the contraction in yields from 10.3 in financial year 20 to around 8% in financial year 22. Coming again to the right chart, affordable HFCs, on the other hand, they were slow in passing on the interest rate benefit to the borrowers, which along with the rising share of high-yielding LAP, resulted in improvement in the yields of around 15.4%, which is largely in line with the pre-COVID levels. Profitability indicators continue to remain below pre-COVID levels. So coming to the graph on the left, while large prime housing finance companies, they benefited from the decline in funding costs, corresponding reduction in the yields, resulting in largely stable net interest margins. Operating expenses to average assets ratio at around 4% remained largely stable and relatively small as compared to affordable to the company's business model and the economies of scale which these large HFCs enjoy. However, continued pressure on the asset quality led to credit costs being relatively higher than the pre-COVID levels. Consequently, the profitability, though improving slightly, still remained below pre-COVID level with ROTA of around 1.8% in financial year 22. We'll come to the graph on the right, which reflects the profitability profile of the affordable segment. So while most of the affordable HFCs were selective in passing on the interest rate benefit to the borrowers, yield remained largely in line with the pre-COVID levels. However, funding costs benefited from the rising share of low-cost NHB funding along with the low interest rate regimes, which boosted their NIMs. With rise in disbursements, OPEX to ATA ratio increased this year to 3.3%. However, it still remained lower than the pre-COVID levels. On an overall basis, higher NIMs along with controlled credit cost boosted the profitability profile of the affordable housing finance companies, which reported ROA at around 3.1%, higher than the pre-COVID levels. Going forward, with the change in the interest rate scenario, the inching up of interest rates will pose a threat to the NIMs of the entities operating in the sector. So large housing finance companies, they've already started the process and we have seen that the rates are going up in line with the rise in repo or MCLR rates. On the other hand, for the affordable entities, the pass-through is expected to be relatively slower, with them being slightly more selective and which may have some impact on the net interest margins going forward. Having said that, the full impact of the repricing will be visible in financial year 24 only, as a lot of resets will happen during the current financial year. Asset quality remained under pressure for the prime segment. So asset quality continued to remain under pressure with gross NPA ratio for the prime segment rising from 2.7 to 3.2% in financial year 22. This rise was mainly driven by the wholesale book, especially the builder segment. So this gets reflected from the graph on the right side. Gross NPA ratio in the wholesale segment increased from 6.1 to 7.8% in financial year 22 due to few large slippages. While for the retail segment, it largely remained stable. In fact, for the retail segment, with the improving macroeconomic environment, collection efficiency has been showing an improving trend. It dipped significantly in Q1, then reported steep recovery in Q2, and we are consequently seeing further improvement in the subsequent quarters. Headline asset quality metrics were also impacted to some extent due to the IRAC norms implementation. So despite the relatively higher numbers of NPAs in the prime segment, we know that large prime HFCs have been maintaining adequate provision coverage and healthy on-balance sheet liquidity, which is likely to provide a cushion to absorb the future losses. Improving economy benefited the affordable segment. So coming to the asset quality of the affordable housing finance companies, they in fact reported improvement in their asset quality metrics, with gross NPA ratio declining from 4.1 to 3.4% in financial year 22. The segment especially reported strong recovery performance in the second half of financial year 22 as the economic activity picked up and the unorganized sector, which the affordable segment caters to, it flourished. Having said that, going forward with sharp rise in inflation, the disposable income might be affected and there might be some risk to the recoveries in the near term. Coming to the graph on the right, so in terms of provision coverage, large prime housing finance companies are much better provided with provision coverage of around 41% as compared to 25% provisioning in the affordable segment. HFCs benefited from excess liquidity in the system. So coming to the funding side, the first graph on the left represents the funding profile of the prime segment. So market instruments continue to dominate the borrowing profile of the large prime HFCs. However, we see that the share of bank borrowings, in the form of term loans, it increased from 25 to 28% in financial year 22. Also, deposits of the housing finance companies, they became more lucrative in the low interest rate regime, and accordingly, their share has recorded a gradual improvement over the past 2 years. Coming to the graph on the right, for the affordable entities, banks, and NHB borrowings, they have remained a major source of funding. A share of low-cost NHB borrowings improved from 17 to 23% of the borrowing mix, which further supported the decline in the cost of funds. Comfortable capital structure. So capital structure for the sector continues to be comfortable, with gearing remaining lower than pre-COVID times for both prime and the affordable housing finance companies. HFCs have been maintaining healthy on-balance sheet liquidity for the past few quarters, given the challenging operating environment. While gearing in the prime segment, as reflected from the blue line, hovered around 5 times as compared to 6 times in the pre-COVID times. For affordable, it stood around 2.4x. For financial year 22, low risk appetite of the lenders, along with cautious market stance of the HFCs and other people, led to the further decline in the gearing on the affordable segment. Coming to my last slide on the outlook for the housing finance sector. So going forward, we expect growth momentum to continue and the housing finance portfolio to grow at around 12% in financial year 23, driven by steady growth in disbursements. Asset quality pressure is expected to ease up, with gross NPA declining to around 3.1% for the sector. Though the sharp rise in inflation may affect disposable income, but we expect the recovery trend to continue. Return on average assets are expected to remain around 1.9 to 2%, supported by controlled credit costs and largely stable NIMs. That's all from my side. Thanks for your time. Over to you, Mridul.
Thank you, Neha. Now may I invite Mr. Sachin Gupta to take the discussion forward. Sachin is a Chief Rating Officer and Executive Director at CareEdge and has around 22 years of experience in leadership positions across credit rating businesses, financials, infrastructure, corporate ratings, business development, and strategy. Prior to this, he was working with CRISIL as Senior Director and managed the corporate and infra ratings. Over to you, sir.
Thank you, Mridul, and thanks, Neha, for a short but insightful presentation. Let me very quickly, introduce our panel. We are very pleased to have quite a, I would say, a heavyweight panel today with presence from HDFC, LIC Housing Finance, and Home First Finance Company. So first, Mr. Conrad D'Souza. Conrad is from HDFC, as many of you would know, in 1984, and he is currently the member of Executive Management and Chief Investor Relation Officer. He's been a consultant to multilateral agencies and has undertaken assignments across the world, including Asia, Africa, and Eastern Europe. He's also independent director on 3 Indian companies and is a commercial of a commercial bank in Sri Lanka. Conrad has a master's degree in commerce, a master's degree in business management, and is a senior executive program graduate of the London Business School. Very warm welcome, Conrad. Then we have with us Mr. Manoj Viswanathan. Manoj is the Managing Director and CEO of Home First Finance Company. He possesses experience of more than 20 years across consumer lending and encompassing sectors such as automobile loans, mortgages, and unsecured lending. He, in fact, played an important role in building the branch-based consumer lending model for Citigroup in India. He holds a bachelor's degree in electronics engineering from BITS, and he is an MBA from XLRI Jamshedpur. Very warm welcome, Manoj. And then we have with us Mr. Sudipto Sil. Sudipto is the Chief Financial Officer and Head of Investor Relations at LIC Housing Finance Limited, and he's been associated with LIC Housing Finance for the last 25 years. He holds a bachelor's degree in commerce from St. Xavier's College, Kolkata, and MBA from Jamnalal Bajaj Institute, and he's also a chartered accountant. A very warm welcome to Sudipto, and let's get the panel going. So, while Neha's presentation did, give a good sense and a bit of compare and contrast in terms of, how the prime housing finance companies and affordable housing finance. But, let me first kind of get the first question to Conrad, and this is more at a, I would say, at a high level in terms of the overall outlook. In general, if we see the environment, today, there's a fair bit of hue and cry happening in terms of, inflation being very high, interest rates kind of moving up, RBI making those sharp movements up in repo rates, etc. And even the same thing seems to be happening globally as well. Now, in this backdrop, how do you see the housing finance business is really, going to grow in the next 2 to 3 years?
Yeah, thanks, Sachin, for the introduction. And to give you a quick summary, I guess there are challenges that we are seeing on the macro. And, from a housing finance perspective, I guess two areas where we need to look at is interest rates, inflation, driven by inflation. And we know that rates have gone up reasonably sharply over the last couple of months. We also have to keep in mind that in addition to the reverse repo rate hikes, there was in addition to the repo rate hikes, there was a reverse repo increase in the April policy. So effectively, funding costs have gone up sharper than the lending rates. But that's more of a correction of the liquidity positions that most people held, and the interest rates being very soft at the shorter end. So some of that was the correction from that perspective. On the other side, we do see, the global issues, the geopolitical issues having an impact. For example, the Russia-Ukraine crisis is having an impact on oil, and therefore that's leading to inflation. You have the supply chain disruptions thanks to China being shut, and that does have an impact on our construction industry. So all in all, these are different obstacles that one is facing. But at the same time, I think the inherent demand that has been there for housing over the last few years has continued to be strong. In fact, if we just step back and go to the pre-pandemic situation, at that point in time, we had rates around 8% plus, and we had a demand which was picking up. And I would say at that stage, the concern really was what's happening to the real estate sector, the developers, because there was a huge amount of stress there. And on the other side, we had seen very high property prices, building up of inventory, and not much traction in the urban areas. So the Bombays and the Delhis were not really contributing at that stage, although the sector was growing. I think if you look at things now, some of those areas have got corrected. Lower interest rates helped, stamp duties helped. The kind of holiday on taking people to bankruptcy code and foreign capital coming into the real estate market. You had the REITs issue which developed. Moratorium, ECLGS, one-time restructuring all helped in absorbing some of that stress. So when you look at things from a broader perspective, the 90 basis points is, yes, a little bit of a setback, but I think should not really impact the housing sector in a big way, because just to summarize, we're still talking of rates of sub 8 at this point in time relative to the higher than 8. And given the high demand that you are seeing, we should not see too much of a setback on the housing finance sector.
Got it. Thanks, Conrad. I would like to get Mr. Sudipto in at this moment. So one is, even your views in terms of, how do you see in terms of the impact of this interest rate hike on the business, on the housing finance industry growth perspective, and also in addition, because Conrad has given a fair bit of points, so you can kind of respond on that. In addition, do you see that there will be what is the threshold? Is it that if the rate of interest, as Conrad said, it's sub 8, so it's still good. But what if it were to go to 9? What if it were to go to 10? The point is, because even from a global perspective, we are actually in quite uncharted territories, the kind of unwinding which US has to do. So no one really knows, how much really, what really will happen. So to that extent, we are in a bit of unknown, while I completely agree with Conrad's point in terms of, the demand still being there. So Sudipto, over to you.
Yeah, thank you, Sachinji. Yes. See, what I always look at, interest rate cycles are a fact of life. And this is not the first time, certainly not the last time that we are witnessing interest rate cycles. In my career of about 25 years, I've seen 5 industry veterans would have seen more. And every time there is a rate hike cycle, we tend to forget the benign environment that was just prevailing prior to it, and it always takes us with a surprise. And no two scenarios could ever be same. But at the end of the day, it's a central bank's response to a variety of factors, including inflation, money supply, and the asset bubbles that might get created if these steps are not taken. So I would tend to look at it as a part of a cycle. And I'll answer your second question first. What is the threshold? To what extent is tolerable? As far as the impact on a monthly basis on an EMI, that is I would say the final calculation at the level of the individual customer. Now, what is the impact of 100 basis points or 150 basis points on an average ticket size of 30 lakhs for a 20-year loan term? I think the amount of increase in EMI compared to a expense that you would make on a Sunday evening outing with family for a movie and a dinner, I think compared to that, the increase will be comparable, and it will not pinch. What actually matters more is significant increases in real estate prices, which deter transactions. But interest rates are important. It's a financial product, but this is not the only driver. We had done business even at 9% home loan rates. We had done business even at 10% home loan rates. And as Conrad sir pointed out, just pre-pandemic, we were selling home loans in the range of around 8 or 8.25. And at that point in time, also, we were clocking 15, 18, 17% disbursement growth on an economy which was comparatively smaller, on an average income levels which were also lesser. So to that extent, I feel that probably the suddenness of the interest rate hike is what has taken us by surprise. But overall impact on the housing sector, I think, will be much limited. At the end of the day, we are talking about a basic necessity. And we've also talked about, we are talking about significant growth drivers and demand drivers which have happened and which have actually got bolstered and strengthened due to the pandemic because of a person's aspirations or a necessity to have a secured asset or a shelter because of work from home requirements or whatever. So if you put these two factors together, what we are actually looking at is, yes, certainly there is an interest rate hike which will have some impact, but whether that impact is big enough for deterring a person's decision for taking a buying decision, the answer is probably no.
Okay, thanks, Sudipto. May I request now for a question to Mr. Viswanathan from Home First, and he brings in the experience with the affordable sector segment. Now, in general, at least my belief is that affordable business segment is anyways the NIMs generally, and we saw in the presentation also in the background of about 8 or ballpark of about 8 to 9%, or at least 7 to 8%. In that backdrop, is it even sensitive? Is the even business of affordable housing sensitive to maybe 100, 150 basis point increase in the interest rates as we're all seeing? And the affordable segment has been growing quite high. Even in last year, I think we saw a number of 25% uptick. So what is your outlook in the current macroeconomic backdrop?
Thanks, Sachin. So I think to start with, I will, echo the sentiments expressed by Mr. D'Souza and Sudipto, that 100, 150 basis points increase in interest rate, means, what is the impact it has on an EMI of a customer? So in our segment, we are lending, and the average ticket size is around, let's say, 10 to 15 lakhs. So in that segment, it might mean 1 or 2%, 1% increase would probably mean 1,000 rupee increase in the EMI. So that really should not change the decision making of a customer, because these are genuine end users who are building, who at that point of time, for whatever reason, are thinking that they need a house. So they need to either purchase or build a house. So ideally, it should not change that decision making. If the impact is, in the prime segment where ticket size is larger, the difference in EMIs can be maybe as high as 5,000, 10,000, etc. Where again, if it's a genuine end user, ideally they would not change their decision. But if it's somebody who's purchasing for investment or other purpose, then there could be deferment of a decision, saying that okay, right now probably I don't want to do this investment, but let's see how the interest rates move, etc. So to summarize, I would say that genuine end users are not going to the interest rate is not the first thing they think about when they're taking a decision to purchase the house. It's a genuine need. Secondly, if you also look at historical trends, the demand for housing has always been, you can say, driven by employment. So there is more employment, there's more income generation. That drives the demand for housing. And if there is a slump in employment and slump in income generation, then the demand for housing tends to taper. That is generally historically the trend in India, as well as if you look at other developed countries as well. So in the current scenario where we are, at least in the medium term, we are expecting 100-150 basis points change. We don't anticipate any impact on the demand itself. And we have to keep in mind that when we started the business in 2010, so we saw the prime lending rates of larger lenders in the range of 9%, right? And frankly, when we were starting out, we were thinking, oh my God, this is 9%. Now, we may have to lend at 10 or 11%. We were like worried about that. But now affordable housing, people don't even talk anything less than 12 or 13%, right? I mean, here we are talking about 100 basis points change. And just, as Mr. D'Souza said, just probably 18 months ago, 24 months ago, we were, actually lending at that rate, those rates, 150 basis points higher. So, yeah, I think it's just a lot of hype that is getting created also because there is, social media and the media is very active. But in reality, the demand, frankly, is much stronger today than it was 24 months ago.
And just a follow-up thing, for affordable segment, even actually the LAP is also a big segment. So the loan is not really a loan for say staying, but it's more as a as a security for taking money for maybe business and otherwise. So
yeah, there is an affordable LAP segment as well. I mean, we are not large players in that segment.
Okay.
But yes, that is also a segment, and that there the lending rates are probably even higher. In the housing segment. Yeah.
Correct. Got it. The next question is, if we see maybe 3-4 years back, and maybe Conrad can respond, and then maybe Sudipto, the major problem with the HFCs, was the book, the wholesale book, as we call it, and that is where the some of them had faced much more pain, some of them faced less pain, but almost all the HFCs which had exposure had a problem in terms of those sticky loans which were not really moving out. Now, what is the general sense that you're seeing there? Two parts to my question. One is in terms of resolving those things. When we say there's a demand improvement, etc. So is it leading to those sticky assets, bad loans, etc. on the wholesale side getting resolved? Because now there's an end user demand and all that. So are you getting that traction there? And secondly, is there a change in philosophy? Because a lot of, and this I'm not saying you have to respond from your individual organization's perspective, but in general, there was a general sense of not touching wholesale because a lot of people had burned their hands quite badly. So it was kind of a, not really a segment to take incremental exposures to and all that. Now, do you think that thing changing now that, we are seeing a little bit of a resurrection in the real estate demand, etc.? So one about the past and one about the future. Conrad, over to you.
Yeah, sorry. So I think I would divide it into two parts. One is the historical problems or the problems of the last 4 or 5 years, which did lead to a stress on the wholesale book. And I would like to say that it's not entirely, very often we say it was the fault of the developers. I think it was circumstances that they had to face, because many of these projects, when conceptualized, did not anticipate a demonetization or a GST issue, which actually set back a lot of projects. Of course, the builders also had their own challenges. There was inflation in prices. There was a hoarding up of stock, and to some extent, I think that was accentuated by lenders providing funding against unsold stock, as a result of which that did not come into the market and just created a kind of bubble. And then things went the other way, and a lot of, I think post the ILFS situation, everyone looked at NBFCs very differently. Everyone looked at lending to real estate very differently. And that led to a huge liquidity problem for projects, which got everyone into trouble. And therefore, that was the peak of the crisis. Since then, it was a big concern. In a very perverse sense, some of the initiatives that took place during the just before and during the pandemic have helped that sector, because you started with the last mile funding possibility through the Swami Fund. There was a lot of international money which came into asset reconstruction or real estate funds to complete projects. Then, of course, we had the moratorium, which was 6 months, gave a relief to projects which were in trouble. But it also made the developers think about how to resolve the problem. And the resolution was by putting out that unsold inventory into the market, and we saw sales picking up. We saw, ECLGS and one-time restructuring helping certain projects. So a lot of stuff happened during that phase, which enabled them to address the issues. There were more players who came in. In fact, a lot of larger, stronger developers came in and signed development management agreements with the existing projects which were facing some stress, and took them towards completion, and many of them are in the process of happening. So I would not say the stress has gone away. It still is very much there, but I would say it seems to have peaked, and we are seeing resolutions in process. Resolutions do take time, and I think till they are entirely resolved, you will see that stress level being there on the books of the companies. But if one looks around, one does see that number seeming to have got arrested and coming off as we go on quarter. As far as the new guys are concerned, I don't think we are in a situation where one should say, because of the past experience, one should actually not look at funding wholesale going forward. Because if one does that, it is going to certainly impact the sector. Because one of the important parts is that to meet the demand, you also need to have the supply. And if you do not ensure that you fund the supply in a organized manner, you can again going to have a problem of a lack of supply for the real demand that we have. So it's important to look at projects. I think the big change that is there between this cycle and the previous cycle, and both very positive. One is that the almost now all projects are under RERA, and RERA does work. So that gives a lot of comfort to the buyer. It also has a control mechanism on the developer, and therefore that old urge to hoard stock and not sell and try to take up prices, now it's all time bound and you have to meet a certain timeline. And I think the second important change that has happened compared to the prior cycle is the whole bankruptcy code and the effectiveness of that code. Because now a developer knows that if he misbehaves, he not only has a chance of losing the project, but his entire company. And I think these are two very important factors which now actually support lending. And the third thing I think is, which all lenders have realized, is that you need developers to come in with enough of capital and enough of skin in the game, and then you give debt over and above that. As compared to past projects, when you review what went wrong, you realize that the developer's equity was a very small amount. And to that extent, today, if a developer does not have that equity with himself, there are enough of funds who are coming in and providing that capital, either in the form of direct equity or in the form of mezzanine capital or subordinated debt, which becomes one more level of comfort for the lender. So I would say, all in all, a good, well-structured project with capital, with the regulatory framework and the good demand is actually very good business going forward.
Got it, Conrad. Sudipto, any similar question? Your thoughts, please.
Yeah, I think Conrad sir has given a very comprehensive summary. Just like to add a few points. Of course, I would reiterate that the real estate sector that we are looking at right now is massively improved from what we had seen about half a decade back. Let us not forget the kind of structural improvements that RERA has brought about, and not only RERA. Probably we would also have to give equal importance to the demonetization and GST as well, which has actually structured the entire sector from various angles, and which has not only helped the lenders take a fresh look, but I'm also talking about the consumers who have got a lot of confidence in getting into projects. Now, let us take a look at the developers themselves. Now, having gone through this series of shock waves back to back for the last half a decade, including the credit crisis post the ILFS event, I think now they have understood the importance of cash flows. That is a fundamental difference. The importance of having cash flows, the importance of having a strong balance sheet, I think is something which has been a revelation, and which is a positive gain for the sector as a whole and for all the stakeholders in this sector. And also coupled with that, the kind of tailwinds that has been brought by the pandemics and the various tools that the government and the regulators have provided, either through subsidized funding to the sector, or the ECLGS, for example, which has been a very good, I would say, no frills attached last mile funding, or the OTRs, the series of OTRs along with the moratorium 1 and moratorium 2, which have actually allowed space and time for the builders to repair their balance sheet, which was very much important. Please note that even before the pandemic, the builders were in a situation of stress, and this probably has come in some kind of a blessing in disguise, that this 2 years with the added advantage of stamp duty waivers and very low interest rate, huge amount of liquidity, has allowed them to repair their balance sheet this 2 years. Any builder who has used these 2 years productively will certainly see improvements. As far as the lenders going forward is concerned, I think it's a case by case call, depending upon the risk appetite of every lender or every HFC or bank. They will have to take a view depending upon the risk appetite. But certainly, this sector, like any other sector, needs funds. We have to be alive to this basic requirement that this, like a cement or a steel or any such industry, also has a need for funds, and we, the lender community, will have to step up and fill that requirement,
right,
for the overall development of the economy and the sector.
Just one follow-up question here, Sudipto. While we and Conrad also mentioned about IBC being there. Now, while IBC is maybe a strong deterrent, for the erring borrowers and developers and all that, but if you look at the ability of IBC to be able to resolve the stuck projects, it's not been that great. We have not really, and there are all these large projects in Noida, and which kind of we've tried all the things, getting new developer and all that, but in general, they are still stuck. It's not like it's easy to step into the shoes. A new guy comes in. Either there is no intent of the new players, or it is regulatory issues. What is your sense? Because we have not seen much of attraction on that.
See, I would look at it this way. It is a delta, positive delta from what was the situation prior to this. And that is again for the sector. What was the alternative?
That I agree. But I was saying more from the past, the book, which is kind of a little distressed book.
I think as far as
your role.
See, I think as far as real estate is concerned in India, on a point-to-point basis, land price appreciates, and this is an appreciating asset. It's not a depreciating asset. It might take time, but my own experience is that on a point-to-point basis, since there is an appreciation at certain point in time, there will be investor interest. There will be somebody to step in and complete the project or take it over. Because please note that this is an appreciating asset. So that advantage lies with the sector.
Okay, got it.
Sachin, if I may just add.
Yeah, please, Conrad, please.
To that single point, I think, yes, the IBC has taken its own time and it does go through a process. But I think just because of the IBC, a lot of developers try to find a resolution before you take them to the IBC. That itself is a deterrent.
There are
resolutions happening even before it goes to the IBC, and it's a combination of tools. But I think there are, as you said, it's a positive delta from the
Got
lending.
Got it. Manoj, one thing that we noticed even in the presentation which Neha presented, the leverage of the affordable housing companies is reasonably low, and that's an aggregate for some of the large affordable housing companies. Now, in general, in the past we would have expected, very high credit losses, and in general, now when we see the past 2-3 years, and it was a big stress event that played out, and now we are seeing almost the tail of it. Uh, how do you see the gearing philosophy of the affordable housing companies would play out? Would they be now looking at, because they have seen the credit cost, not really ballooning up so much, even in a time of distress? Is it possible that the companies will be, comfortable going with a higher leverage?
Sachin, I think the gearing of these companies is a reflection of multiple things. One is the size itself, right? I mean, affordable housing is a relatively newer concept, and most of the companies are 5 to 10 years old. Smaller in size in terms of AUM, etc. And also in terms of rating, in terms of their credibility in the market, they're far younger. So it's I think most of the good companies feel that it is prudent to maintain more cash on the balance sheet. So that is one aspect. And secondly, I think right up to demonetization, I think it was a good period for affordable housing. And I think till demonetization, people did not realize that there can be a period of 4 or 5 years of massive disruption. So right from 2010 to 2016 was a very benign period in terms of liquidity, in terms of overall environment. So but post demonetization and the ILFS crisis, etc., I think the companies realize that it's better to keep the gearing low, have more capital. So I think that has also played a role in keeping the gearing low. So I think it will require, fortunately or unfortunately, right, over the last 4 to 5 years, we have really not got any breathing space. Right. I mean, just when you think there's a crisis behind you, there is a crisis in front of you. So from that perspective, I think companies which kept more capital, kept the gearing low, have done well, during this period. So I think we are just coming out of COVID, and there is now inflation and various other things staring us in the face. So it will require a benign 3 to 4 year period when everybody including the environment, gets comfortable. I mean, lenders, rating agencies, everybody becomes comfortable with a slightly higher gearing. So I think till then, smaller companies like us and in the affordable segment are going to keep their gearing low and keeping more are likely to keep more cash. So I think that is really where we are.
Got it. Thanks, Manoj. Sudipto, one question is, now that RBI is kind of also looking at tightening the lending guidelines, a lot of times NBFCs, and this is more from a wholesale lending side, NBFCs fulfilled a role because in some segments, say land acquisition, etc., the banks could not lend, and that is where NBFCs or HFCs would kind of fulfill that role. Now, with this likely tightening of the regulation, do you think that will create some challenges for the growth of the HFCs?
No, I don't really think that is going to be, because if you look at the percentage of the overall assets under management for any of the HFCs, builder segment is generally, in the teens. In some cases, it might be 10%, 12%, 15%. And that kind of appetite can be certainly met through construction finance and the permissible modes of funding. So I don't see that HFCs will really have to stretch that much. I think that should not be a problem.
Got it. Manoj, one quick question. We have seen, and you mentioned about, relatively nascent, I wouldn't say nascent, but a young age of many of these, affordable housing finance companies. A lot of them have backing of private equity, and that is what really given them the risk capital to grow. Do you see that changing? I mean, while it is too early to say, but is that a concern that you have now with, this whole global move of, dollars moving away from emerging economies and moving to, more, higher if US treasuries can offer better return and all that. So there is a kind of some bit of a flight of capital happening. So could that impact the access and the growth capital which the private equities have pretty much funded many of these NBFCs?
Yeah, definitely. I think some of that will happen, and I can only feel glad for us ourselves that we are past that stage where we are small. We were small, and we had to raise money from the private markets because probably for the next 12 to 18 months, that is a market that's probably going to be a little more cautious in the new investments in the country. So yes, I think smaller companies, with smaller AUMs, which are still private, which need to raise capital from private equity, probably going to be a difficult time.
Okay, got it. One last question from my side, and then we will open the panel. We saw in the presentation that on the asset quality side, and this is to Conrad, the asset quality, while it has been kind of in 22, it's kind of improved from 21. If you look at the GNPA or NNPA numbers, but still it seems to be high then. So what is the feel on the ground, Conrad? Are we kind of seeing month on month improvement? Because when we say economy is heating up, or in some ways the employment is good, that's a general thing you're saying about even the new business being generated. So on the NPA side, how does that look? And maybe some kind of a forward-looking sense that you have.
So on the NPF side, if you're looking at 22 vis-a-vis 21, if I have to look at, say, the wholesale book, I think generally, as we discussed earlier, I'm not going to get into detail, but it seems to have peaked, and as we see resolutions, you will see that number coming off. So I don't think there is fresh accretion to that book. Interestingly, during this phase, people, generally lenders have been a bit cautious on taking incremental debt. So you also have the denominator not growing. And to that extent, that number looks a bit on the higher side, although resolutions are happening, but rather slowly. As far as the retail book is concerned, I think almost every lender has reported improved collection efficiencies during this period. But the numbers may not necessarily reflect it because it is very strictly not a like-to-like comparison. For most in most of the HFCs, in fact, for all of us, we had to report the December quarter based on the November 12th circular. And therefore, there was an uptick in the numbers. And of course, in the next quarter, in the year end, people chose to either report it back as per the original or continue reporting. But if one has to look at sense on the ground, I think there's certainly a significant improvement between 21 and 22, adjusting for this November 12th circular, and collection efficiencies actually reflect that. A lot of the concerns on whether people have lost jobs or people have had to take pay cuts in certain sectors, I think that they're all back now on track. Those which actually needed the support took that one-time restructuring, and we have not seen too many slippages from those accounts which actually took that option. So overall, I would say 22 to 21, adjusting for the revised norms of NPA, there has been a significant improvement. And I guess my gut feel is that just like housing finance companies a few years back, over a 3 to 4 quarter period, adjusted from the 180 to 90-day kind of recovery norm. Very similarly, people will put their act together, put their systems in place, and very soon, I would expect the NPA number to be the same as prior to the November 12th circular. So I would say overall, yes, a fair bit of improvement since 21.
Got it. Thanks, Conrad. So with this, we kind of come to the end of the moderated panel discussion. We will now open the floor for Q&A. Mridul, do you have any announcement to make?
Sure. Thank you, sir. Dear participants, for your queries, you're please requested to key in the panel your questions.
Okay, I've kind of been getting some questions. The first question, maybe I'll ask Sudipto to answer this while it's a general question. It is about the level of intensity of competition between the lenders. And are we saying, is it getting too competitive and therefore leading to finer margins and, greater costs?
See, we are in a competitive sector. If you look at this sector, right, for the last 10 to 15 years, this has been one of the most intensely competitive, but the size of the industry, the size of the pie is also increasing. So while conceding the fact that yes, the competition is there, I wouldn't say it has intensified or it has worsened any bit more. There have been, I would say, some consolidation happening within the industry. So little bit of space could have been created. There is a little bit of further aggression from the point of view of the banks, but overall, I would say the pluses and minuses more or less balance it out. And again, coming back to the size of the pie, it is growing and it has been growing significantly and consistently. So I would say that for most of the larger players, it continues to be more or less similar at the similar pace or at the similar level.
Okay, got it. Maybe next question is more on the affordable side. I'll request Manoj to respond. It says, for the past few years, government had provided a lot of schemes, PMAY, urban and rural, to support housing. And indeed, home ownership had increased across states. In that context, how do you see the growth of affordable housing finance for the next decade?
Yeah, so see, housing schemes, definitely help the subsidy scheme, at least the credit-linked subsidy scheme, which we implemented, that the housing finance companies implemented, definitely helped the customers to build a cushion. And I think many customers would have probably benefited during COVID because their installments are reduced by about 10 to 20%. So somebody who was paying a 10,000 rupee installment had to pay only 8,000 because of the subsidy. So that benefit definitely came through, and but that has been withdrawn as of effective of 31st March of this year. But we are not seeing an impact on the demand. The scheme was more support for the customer to in repaying the loan. It looks like in hindsight. It was not a motivation or you can say incentive to actually buy a house or take on a loan, because at the end of the day you have to see that the customer was actually making a commitment to make an installment payment for 20 years. I mean, the subsidy was of course reducing the installment, but ultimately instead of 100 rupee installment, he had to still pay 80 rupees. So it is not that he the loan was being waived off, or it was reducing to such an extent that it became very easy for the customer. He still had to make he or she had to make 80% of the EMI payment. So only people who are really in need of a house and who want to make the 20-year commitment would actually take a loan. So which is why we always said that this is not going to impact the demand, and we are not seeing that impact on the demand as well. At least what we have seen in the last 2-3 months.
Okay, got it. Next question, maybe I'll request Conrad to take this, is with fintechs making their presence felt in various segments, do you think that housing finance is also going to face increased presence and pressure from such fintechs?
See, as far as fintechs are concerned, I don't think, and we know some of the recent pronouncements by even the RBI kind of confirms it, is that fintechs cannot replace the more traditional lenders. But I certainly think there's a big role for fintechs to play, and going forward, you will see more and more collaborative exercises done by the existing incumbent players with fintechs to actually increase reach and make it cost effective, make it as you get the next generation coming in, they'll be much more savvy with digital tools and such stuff. And therefore, both collaborating will certainly increase reach as compared to the traditional way of setting up branches and sending people out to do loans. And also, I think in terms of regulation, we have seen not only for the fintechs, but even for the non-bank finance companies, including housing finance companies, the most stringent regulation as far as liquidity is concerned, asset quality, provisioning. So all that will come into play. And like just to summarize, yes, fintechs will be an important player, but in a collaborative mode rather than in a competitive mode.
Got it. One more question. I'm just not able to, but anyways, let's try to kind of ask this. They're saying that most HFCs have loan to asset values between 50 to 70%. Hence, wouldn't most companies be writing back the NPAs booked after the November circular? I think they're talking about the recoveries happening on account of this thing. So, Conrad, maybe if you can take this. Is there, I mean, what they're saying is that maybe you provided for higher distressed loans, but now that you may be able to do recoveries, and could that lead to write-backs of those provisions and therefore increase in profits?
The November 12th circular has only been deferred for a couple of quarters. By the time we get to September, we are back into that. But yes, if one has, like I said, someone may have slipped into an NPA because he's not been paying regularly or by the technicality of that daily stamping, and he gets his account and his act together, yes, to that extent there will be, but it's not going to be much. In fact, I think even when the circular did come in, for most of the NBFCs, because we are already on the Ind AS form of accounting and we carry a reasonable amount of provisioning, the provisioning impact was not as much as the fact that the NPA number went up. So from that perspective, what will happen to my mind is that the NPA number will get corrected as you put your systems and processes in place, and also the borrower understands that because of this technicality, he does become an NPA. It could impact his credit standing, etc. And provisioning, is, I don't think, going to be a material reversal.
Okay.
It could vary for certain companies, but if one is talking as a sector as a whole, I don't think so.
Got it. I think that's helpful. One more question. This is on the restructured book. Sudipto, if you can take this. It says on the restructured book, what is the initial assessment on the asset quality performance for the portion which has already come out of the moratorium? And when do we expect majority portion of the book to come out of moratorium?
No, as far as the industry is concerned, I think the moratorium the cases are going to exit the moratorium beginning. Maybe some might have exited in March, and for the next maybe 4 to 5 quarters till the middle of next year. And as far as industry, whatever information is there in the public domain, so far so good is what we understand. Because in the interim last several months, the negative impact of COVID has also receded. Economic activity has improved. Income levels have remained stable, or whatever income pay cuts have happened or income losses have happened have also got regenerated or restored to some extent. So I guess that the situation as of now is so far so good.
Okay, got it. I think we heard a similar point from Conrad also earlier when he was making other point in terms of the book that was restructured. Conrad, you also have a similar sense?
Yeah, I would agree with Sudipto. Because, and I think at least, from the information which is, on the one-time restructuring, for example, as a part of the disclosures, especially for the listed companies, you have to disclose not only what is the one-time restructuring outstanding, but what are the accounts that have slipped into NPA. And if you really look at those numbers, it's a very, very insignificant number.
Manoj, how is this playing out in the case of affordable portfolios?
So affordable portfolios, again, the restructuring people have done very selectively because nobody wanted to restructure all the accounts and then face the music after 1 year. So I think people were very selective. I think like we did about 80 basis points. Companies did probably anywhere between 50 to 50 basis points to maybe 200 basis points. So out of which probably about 15 to 20% have slipped back into NPA. So it does not, as the others mentioned, it doesn't really make a significant impact on the, overall NPA or the stress levels.
Got it. Great. So there are a few more questions, but I think most of them we have kind of discussed in some way or the other in our various conversations. So I would just like to, thank all three of you for, taking time out. And I think you also gained some value, and I'm sure our audience would have certainly benefited from this. Care keeps doing such webinars on a regular basis. So please connect with us on our future webinars. Mridul, do you want to just close it formally?
Sure, sir. It was a privilege hosting you, sir. Thanks to all the participants also for taking the time out and being a part of this Care Ratings webinar. And we look forward to your participation in future also. With this, I'll request the tech team to log off, please. Thank you again to all.
Thank you.
Thank you, Sachin. Thank you, sir.
Thank you.
Thank you, Sudipto. Thank you very much.
Thanks a lot.
Yeah, bye.